This is the Fixer Punk Podcast. I'm Grayson Peltier. First off, apologies for the late episode. I have both been strangely exhausted and also trying to take some time to enjoy myself and rest before the recession comes. And that's the first thing here. This episode is going to be more on the how to personally protect yourself from some of the effects of the upcoming recession and the situation we're seeing in the banking system with SVB, Signature Bank, First Republic, who has just been basically saved by other members of the banking industry, how to protect yourself if you're doing a little better than average right now. That's mostly what this is going to be focused on. But I think the first step to really preparing yourself for a possible recession or for some sort of economic collapse or bank run is to understand the narrative and understand what this is and what this isn't. And the first thing that it isn't is the thing that I caught myself saying just now, which is an apocalypse. This isn't some spiritually ordained event outside of the control of all of humanity. This also isn't a natural disaster that just occurs because that's how forces of nature work. Forces of nature dictate that we must have a recession and a bunch of people lose their jobs and their money and banking systems collapse and stuff doesn't get to people in the way that it did before. That isn't some force of nature. It's something that is invented, is part of the system, and is the way we have designed things. And I think the easiest way for us to understand that is to see what happened during COVID. Stock market tanked. It was astronomical, severe shocks to the market because of something that occurred through the natural process of how diseases kill people and cause illnesses and cause people to need to keep themselves safe. But the economy did not fully collapse because we made a conscious political decision to solve the problem and to protect the most vulnerable in our society with financial assistance. There are things that could have been done better, of course. Lots of things that could have been done better. Lots of regrets. I think we all have regrets about that time period ourselves, whether on an economic or on a health level, on a personal level. But the point here is that these things are a choice in terms of policy and operation of businesses and the economic system that we have. We can choose a different outcome. We can choose to not have people hurt so much and not to put the burden of fixing the economy, under quotes, on working class people and people who are more vulnerable, people with disabilities or who have limitations or differences that make them less appealing in the job market. We can choose to not put the burden on those people, just as the choice has been made to come in and rescue Silicon Valley Bank and Signature Bank and make sure that all the money that's deposited there is 100% available and none of it will be lost. And we can go on and on and on about whether or not this is bailout, not bailout. The expert heads here say that this is not costing taxpayers a dime, which is a good thing. Overall, I am going to have to say that it's a good thing because there are a lot of tech companies, startups that we're going to miss payroll, and those workers deserve to get their paychecks. And this move ensured that they got them. But let's talk about how you can protect yourself in these situations. First off, we got the mental armor on there. We know that this isn't just some natural event that just happens because. So mentally, you know that any sort of gaslighting you hear from the news media saying, oh yeah, this is just something that naturally occurs. We have to trim down, chop down workers' pay. We have to start taking away benefits from you. We have to focus on paying off the national debt when that whole debt ceiling fight comes. So that means that you're not going to get your food stamps. You're not going to get your medical care. You're not going to get your education assistance. You're not going to get your student loan forgiveness because the laws of nature dictate that we have to pay off the national debt and we have to balance the federal budget, and the laws of nature dictate that that burden must fall on you, the normal everyday citizen, and not on the rich who are hoarding all the money. Now you're insulated from that, and hopefully that helps you mentally. You get mentally clear and you're not blaming yourself this entire time and saying, if only I was good enough to be like these rich people, then this would not be happening to me. No. Somebody made that choice. Somebody politically made that choice, and you could make a better political choice. And sucking up at the ballot box to the wealthy people who say, oh yeah, if you agree to this anti-inflation measures, letting our interest rates soar to 15, 20, 30%, obviously I'm exaggerating there, then we will bring down your gas prices by a few cents. We'll bring down your egg prices. We'll bring down your food prices. That's not going to work. You're being given a false bargain there, and that is a choice. It's not a law of nature. But now that we have that over with, specifically bank runs, because that's what everybody's thinking about right now. Is my money safe where I am banking right now? Am I going to be able to have all my bills clear? When I write out a check, is it going to clear tomorrow, or is it going to not clear? Am I going to wind up not being able to pay my mortgage, my rent, buy food because my bank went down? Is my money safe? And the very, very simple answer is, if you have less than $250,000 in a single bank or credit union, your money is safe. You're not going to lose it. Even if these extraordinary measures that were taken for SVB are not taken for whatever bank you're in, you're going to be safe. You're going to get your money back. That money is insured. There are some extremely rare exceptions with a few small credit unions that are insured by a private company. But as long as you're in an FDIC or NCUA insured institution, you're good. Now, the little caveats there. Typically, it takes a few days for the FDIC or the NCUA to transition operations. Usually stuff should clear. There's kind of, the FDIC and NCUA have more technical explanations of these things on their websites. But if your money is below the insured limit, you're generally going to be safe. And there are ways, if you have money that is above the insured limit, there are ways to make sure that it is fully protected. And that's like, and the first thing is that if that money is, like, say, in an IRA or 401k, those things are generally considered to have a separate insurance limit than just your regular checking savings account. And of course, stuff like securities, bonds, stocks, investment stuff isn't FDIC insured, so that limit doesn't apply to it. And that's obviously subject to all the market volatilities that you should be well aware of before investing in those kinds of things. So that's the very, very bare minimum fundamentals. You don't need to panic. You don't necessarily need to start grabbing money out of your bank. You don't need to start raiding ATMs if you're the average person. But the little caveats are that maybe your money may be a little bit less accessible during the transition period. They got SVB going, I think it was like a Wednesday or Thursday, and then to Monday they had stuff restored, the FDIC did. And I think they said that checks still cleared and that some transactions still went through. But it took a little bit more time. There were some organizations, some businesses that apparently their payroll got halted temporarily in the process for a few days there. And that's really, obviously, for businesses, that's the big risk, is where the business is putting in, because everyday transactions for a business could be in the millions and millions of dollars they have to hold in an account, and you can't really have a process of separating. If, let's say, your expenses as a business that you're paying out are like $1 million a month, it's not really effective to have bank accounts that are each $250,000, and so that you have them in separate institutions and it's all insured, your regular operating account. And that's why that threat was there for the tech industry specifically, that was banking at SVB. But for the average person, that's not going to be so much of an issue. What this is bringing up, though, is a slightly related issue, which is that the whole tech ecosystem, the tech VC ecosystem, is very, very shaky. So SVB had lower deposits than normal because venture capital firms weren't giving away or investing as much money into tech companies as they normally would. And that kind of shook their depositor base. And now there are a lot of tech startups that are coming up that actually are operating sort of like banks. They're offering all kinds of like banking services to people through the internet, all like the app-based banks, all the stuff of like, ditch your bank, use this app with this cute like single word, 5-letter, 4-letter name with all these different benefits that they offer. And those products generally, unless you're in some sort of crypto-backed nonsense, which, of course, please, for the love of God, stay away from that. Don't put a dime into crypto that you're not prepared to just completely lose. But a lot of those they're using an FDIC insured bank. So the money is going into an insured bank, but all the infrastructure, the ecosystem of the app, the card, the customer service is handled by a company that is a tech company that's probably being funded by a venture capitalist. And a lot of these tech companies can and do go down. A lot of these tech disruptors, startups, they're inherently unstable. So while your money may be safe in the bank where it's in, you may have a bit of difficulty dealing with how to get it out of said bank if that tech startup happens to fail. So you want to be a little bit careful. If you're using some sort of app-based bank that's not in the name of the bank itself, you want to be a little careful. And generally, my general rule with these kinds of things is to have multiple accounts. Even let's take away the risk of a bank run, the risk of bank runs, all this stuff that's going on. My rule is just to keep money in multiple institutions because there are a few benefits to that. With the good interest rates, you can get a lot higher interest rates on different terms of CDs or savings accounts that are a higher yield by choosing to shop around and use multiple institutions. The other thing is that like if you carry around a debit card in your wallet and you lose that wallet maybe a couple days before you get a new debit card in the mail, if you have your emergency fund at a different bank and you have a debit card for it, you can withdraw that money right away. You have it at your house in a safe place, in a lockbox maybe, something like that. You can access that money real easily while you're waiting for your new debit card to come in the mail. And then the behavioral aspect of personal finance too. You have that money in a separate place. If it's like an emergency fund or money that you're saving away for investment or for a specific goal, for a specific savings goal, that money isn't going to show up right away in your bank's mobile app, website, whatever. It's sort of out of sight, out of mind. And to get at it takes a little bit more effort. You have to dig up that debit card from your lockbox or whatever, or maybe it doesn't have a debit card. Maybe it's a CD, and you have to wait for that CD to mature in order for you to be able to get at that money. So behaviorally, you're not going to spend it as impulsively. So generally, there are only benefits to using multiple institutions. But in terms of like your primary, your main everyday banking, you maybe want to be a little bit careful if you're using a fintech, one of these app-based type banks. Now, there are some interesting opportunities with some of these tech-based online banking institutions in terms of securing your money. And it's actually using a technique that brokerage firms have used for years, like stock investment houses. We're talking about like your Fidelity, your Morgan Stanley, E-Trade, Charles Schwab, those kinds of institutions. they have long offered what are called extended sweep deposit accounts, or ESDAs for short. And what these do is, instead of holding $250,000, because your insurance limit is $250,000 per person per institution, with the exception of different ownership categories, meaning that joint accounts are a separate insurance limit from a single account, and retirement accounts, like I explained, are a separate ownership category. If you're holding an IRA CD, that's considered to be under a separate $250K limit per institution. But what these things do, these extended sweep deposit accounts, is they take money that you deposit into your brokerage account, the cash portion of it, not the stocks, bonds, investment portion of it, and they deposit up to $250K at one bank. And then when you're over $250K, they put the next $250K in a different bank, and then the next $250K into a different bank, and so on and so forth, up to, some of them are $1-2 million, depending on how many banks they work with. So your money is insured up to that limit. You get the FDIC insurance for each bank. So with one account, with one debit card, one set of checks tied to it, you have $1 million, $2 million, $3 million in insurance. And those are very interesting. Those are very interesting tools that the investment field has, and now some tech companies are now doing that as well. And this is for businesses too. Brex is a expense management and banking tool for startup businesses. I think you have to qualify. I think it's only for businesses that are relatively successful, and that's who would need this, honestly. But they do that whole sweep account concept too. First $250K goes to one institution, next $250K goes into another institution, next $250K goes into another institution, but you're still accessing it through one account. Of course, you still have the tech startup risks. If the company that you're doing business with, that your customer service, that your debit card, that your checks, that your mobile app, your website are administered by, if they go kaput, it may be a little difficult for you to access your money. But generally, and I'm saying generally, I'm not a professional in any of this. Don't trust anything I'm saying without verifying it yourself and asking your own professionals. And that applies to everything I say on this podcast. But generally, you should be safe as long as those underlying institutions are insured and you're below the insurance limit in the aggregate, whether it's that sweep account or anything else that you have at that institution. They all go toward the same limit. But that's a potentially interesting tool. And I also was reading about how small community banks, because small community banks are the ones that are going to get hit by these bank runs quite a bit. And what my opinion is that I generally prefer to do any sort of banking business that I can with a credit union, because unlike some of the First Republic banks of the world, First Republic, I was actually looking at them a little bit as a bank, but they tended to charge a lot of high fees, especially for business accounts. They seem to be very geared toward taking in very, very large deposits from wealthier depositors, and they may have a bit more of a concentrated risk profile, whereas a credit union tends to have a much more distributed risk profile. Of course, all institutions stand on their own. Each institution can have its own different risks, regardless of what kind of institution it is. But I tend to prefer credit unions because they tend to take fewer of ridiculous risks or have industry over concentrations. There are some that are tied to a specific industry, but usually it's tied to the individual workers, and they have more turnover of working with average normal people, and they're reinvesting their money into your community, into things that are into people and sometimes businesses that are in your community, rather than some sort of far-flung larger project. And they're more accountable because members are owners of the institution. Credit unions tend to be more accountable. You tend to get higher interest rate payouts on savings at credit unions, as well as lower interest rates on stuff like credit cards and car loans because they don't have a profit motive. So overall, when I say bank with multiple institutions, I'd recommend you make one of those a credit union or two of them. But some smaller institutions are going to get hit with people getting worried because they're like, oh my, let's say you have somebody who's pretty successful in life, who has like $1 million in a bank account. People are going to start moving that money out of like their community bank. And already there's been very, very high increased demand for the quote unquote too big to fail banks, the Bank of America, Citibank, Wells Fargo, Chase. Those kinds of institutions are seeing a lot of demand for their services. And community banks are going to lose out. And some of these community banks, obviously I spoke about credit unions and what all the positive stuff they do for communities, but a lot of smaller independent community banks are also very much pillars of their community. They're invested in their community. It would be sad to see a lot of them go down. Further consolidation in the banking industry is not something we need to be applauding. It's not something that's good for the economy, because these smaller institutions will be the ones who will step up, say when the PPP loans were coming out. They'll step up and they'll say, oh yeah, we'll help the businesses in our community, in our town, get access to this program for the SBA. There are a lot of institutions that are smaller institutions that are doing a lot of good work with small businesses, keeping them going, with local nonprofits. They'll be more flexible. Perhaps if you're involved, like I've spoken a bit about, like activism and organizing infrastructure, you're forming a nonprofit or something like that in your community, they might be more willing to work with you, more flexible in helping you with loans and banking services than the big bank. Some of the big banks can be pretty hard to actually get a business account from, strangely, if you're not fully incorporated. But what some of these institutions are doing is they are trying that whole sweep account strategy of having you have an account at their bank, but they're able to move your money over $250K to other fellow smaller institutions, so you stay below that $250,000 per institution per person limit. And they're doing this to a service called IntraFi. I haven't really seen any institutions in my community use this, but I'll put a link to it in the episode notes. But basically, they're working with small local banks. Doesn't look like it's credit unions, but for people that have larger deposits, they can flip them over and you still use the same accounts. That's kind of an interesting thing that I thought I'd bring up there. But yeah, banking consolidation is not something that we should be necessarily clapping for. If an institution needs to get bought out in order to keep it stable, then sure, we need to keep the system stabilized and ensure people are confident in the financial system. And that's why there are a lot of people on the left who are saying, well, you got to let the banks collapse. I don't know if we want to do it with just random smaller institutions and have people lose money and have businesses that are paying out payroll not be able to pay out payroll. There are better ways to get justice for people than letting people who are innocent lose their money. But you don't need to, you shouldn't, especially if you're one of those people who's banking at their local credit union, an institution that's doing good in your community. You don't need to worry about panicking, going and grabbing all your money, taking it out, and banking at another institution. That is really the big message here. You don't need to worry about doing that. It's probably not a good idea. If you have some sort of immediate need to pull out money or whatever, you need to use it in some way, then obviously do that. But you don't have that much to worry about in terms of bank runs if you're the typical person. And you want to look at this. I mentioned the sort of behavioral angle around putting your money in multiple institutions. You want to look at the options, the opportunities, especially at your local credit unions, to earn a higher interest rate on your money while you can. There's been a little bit of discussion that the Fed may be slowing down some of the rate hikes. Maybe they're going to cut it sometime after June. But if you have, and this is who this episode really is geared for people that are doing better than average right now, financially. If you have some money and you have it just randomly sitting in your checking account balances after the pandemic, I haven't seen the latest statistics, but up through like 2022, people's checking account and savings account balances have gone up by a lot. If you have just random money sitting in a checking account at a big bank, or even at a smaller bank not earning any interest, and you know that you're not going to need to use that money in the short term, or a somewhat medium longer term, like I'm talking 6 months to a year to 2 years, there are some really good rates out there for certificates of deposit, CDs. So maybe you want to take advantage of those within the next month or two, especially so that you have that behavioral incentive of not wanting to spend that money. If you know you're not going to use it, and I'm not talking about, this isn't like your regular emergency fund money, this is money that's on top of that. Money that you know you're not going to use and that you know you're not going to have to take out an emergency because CDs are locked in. There are penalties for withdrawing from them for most of them. Read the fine print. But maybe you want to take advantage of some of those interest rates. And I'm doing that myself. And the way I typically structure it is like, you put some money in the 6-month CD, you put some money in 12 months, you put some money in the 18 months, and then I have a few in like even longer terms than that, because you can lock in those interest rates and the interest rate stays constant. Unlike with the savings account, that interest rate could vary. So right now, if you have some money, if you have a little bit of money and you want to set it aside, you want to make sure that it is locked up and that you can't spend it, this is probably a good time to buy CDs. Now, I've heard that the Fed may be raising they're going to be meeting, I believe, sometime this week, that the Fed may be raising rates just a hair. So maybe they'll go up a little bit. But it seems like banks are kind of some of them are curtailing the higher interest rate CDs over the longer terms, like the terms over 12 months. So you'll see higher interest rates sometimes on a 12-month CD than on an 18-month, which is kind of abnormal. Because they're like, at 18 months, are we going to be able to pay out that interest because the market is going to shift, the Fed's going to shift to reducing interest rates a little bit, so we'll be losing money on that. So that's a strategy that you want to take advantage of. And then the other thing that you want to make sure of is to avoid scams, avoid panicking. Because a lot of times, and this happened unfortunately to my family, is that as the stock market started to crash in 2008, everybody panicked. And that included people in my family who had a sizable amount in savings or in a retirement account. And there was somebody on the radio who was advertising safer money solutions, things that could pay out good even when the stock market was crashing. Unfortunately, those investments, one of them turned out to be a Ponzi scheme. The others turned out to be illegitimate and lost almost all of their money. And they had to go and file a lawsuit to recover it. I actually had to help one of my family members through the process of filing lawsuits and discovering assets. I learned so much about securities law and the FINRA arbitration process, the judgment collection process, all these various aspects of the legal system. I think that's part of where my passion for law came from. And at a time, I was considering becoming an attorney after this, is because seeing the devastation of this investment fraud and learning how to recover this money, and then telling the lawyers and keeping on pushing them and advocating to make sure that my family got taken care of. But don't make that mistake. Don't just randomly start going into, oh yeah, I heard this investment advisor on the radio or on the internet or whatever. Somebody saying, oh yeah, stock market's crashing, sell and go into crypto. Stay away from those kinds of things. Stay away from private placement investments, Regulation D investments that are like unregulated, stuff that you just don't really understand. If it sounds too good to be true, it probably is. If the investment advisor is not a fiduciary, ask them that specific question. If they're a fiduciary, and if they're not, then you don't need to deal with them. Find someone who is. It may be better to just stay the course in the stock market if you have a retirement account, a 401k, whatever. Because these things usually do rebound. Our government is very, very inclined, for better or for worse, to bail out banks. If you bought Bank of America stock when it went down like crazy in 2008, and you held on to it after they got bailed out and after the economy recovered, you probably make a crap ton of money. This is not investment advice. This is not financial advice. You should get good financial advice from a fiduciary if you happen to be in a financial situation where you have a bunch of money in a retirement account or a brokerage account or what have you. But avoid those kinds of common traps, because the fraud in the financial market is a very, very effective way to separate working class people from their money and transfer it to the upper classes. These kinds of scams, these kinds of tricks are how they are able to finance their dreams, and you are not. Because they know that they can create a flashy ad campaign, they can play on your fears, and they can take your money. And there isn't that much you can do, because you steal a $5 candy bar, you are going to be heavily, harshly prosecuted under the eyes of the law. I don't care what Fox News tells you about the quote-unquote soft on crime policies. It just isn't really true. But you steal $5 million from somebody, you'll get a judgment, and that person has to advocate and fight for it like their life depends on it in order to get back an aggregate of $500,000 across all of these investors who together invested $5 million of their retirement money. And they're all those people are screwed because they banked on their life savings going into this into this investment. And sometimes it's not even $5 million. Sometimes it's $5 billion. And oftentimes they don't really get jail time. They get a few weeks. They get probation. They're oftentimes allowed to keep a lot of the money for living expenses until their trials happen, which a trial can take like 3 years. They're out on bail. They're free. Meanwhile, a poor black kid is stuck in a prison cell for months or years for something that they maybe didn't even commit because they couldn't afford bail, couldn't afford a good lawyer. That, sadly, is how the system is. So don't let yourself get trapped by people that are scamming you out of your money and playing on your fears and telling you this is the way to keep your money safe. It probably isn't. If it's too good to be true, probably is too good to be true. And then lastly, I do want to say, outside of like the actual protection of your money, making sure you have money in multiple places so that if your bank happens to go through one of these FDIC, NCUA transitions or whatever, even though you're insured, maybe stuff won't clear for a few days, and you're able to access your money quickly because you have some money at another bank in your emergency fund that's separate from that, and you have that as an emergency backup plan. I would say not to be too prepperish, but make sure that you keep all of like your essential goods, food, stuff like that, pretty well stocked in your house, because if you like lose a job or whatever, there's a difference between losing your paycheck and having like a few weeks of stuff already in the pantry and already having your medicine bought ahead of time, already having picked up your medicine under your employer's insurance plan, rather than, oh my God. And this is if you can do this. Again, this is for people who are more financially secure than typical right now. This is for people who have luckily gained a little bit from this little bit of help that has been put into the economy, this little bit of care and consideration that's been made for the typical person through the COVID crisis that is now being pulled away to advance the recession storyline and force you back into line as peasant laborers. Before that happens, you want to protect yourself a little bit if you can. And of course, continue with solidarity, unionization, workplace organizing. We don't have to buy into their storyline. We know that this is unnatural. We know that taking care of people, making sure that they're all taken care of, is not going to collapse the world economy. We know that. We learned that already. We learned that through this pandemic. But if you're just generally a little bit more prepared ahead of time, and you're not like, oh my God, all my money's been spent and I have no more money coming in, and the pantry shelf is bare, and now my health insurance is gone, so I have to pay full cash for my medicine, which that's a whole different episode. I could talk about like how to deal with it if you unfortunately get hit with some kind of layoff and now you're no longer in a better than average financial situation. Now you're in a horrendous financial situation. There's a lot more advice I can give on a future episode of that, because I've been close to that a few times. Luckily, I am in the slightly better than average category right now. But hopefully some of this information was helpful to you. Now, if there's anything else you want me to cover, anything else you want me to discuss on a future episode, then please let me know. You can always go to any of my social media at FixerPunk on TikTok and Instagram. TikTok is updated very, very frequently with current events coverage and other fun stuff. Please be nice in the comments. Please show your support. At Grayson Nation on Twitter, also pretty regularly updated. You can also just reach out to me via email, Grayson, Greyson, at offspeedsolutions.com. And now we also have a call-in line. If there's some sort of dilemma, some sort of question, concern, something that you want me to discuss, something you want me to take my lifetime of fighting the man and fighting institutions, and you want me to maybe comment on it a little bit, or if there's something that you're pissed off about, or maybe you just want to give me a really nice compliment. Maybe you just want to make my day a little bit better, make me actually feel good about what I'm doing here. You can call the number, 844-477-PUNK. That's 844-477-7865, and leave a message. It may even get played here on the show. Thank you so much for joining me. Please come back for the next episode. Really appreciate having you here. Really appreciate that you decided to spend some of your time today with me.